Hello everyone and welcome back for another edition of the Money Pros. I'm Oliver Tutt, Certified Financial Planner Practitioner. I'll be your host for the next half hour as we talk about all the issues related to your money, how to make it, how to keep it, and hopefully how to help it grow. Let me tell you what we have in store for today's show. We've got a lot going on. First up, interesting proposal in the Rhode Island State Legislature to make personal finance education a mandatory graduation requirement for Rhode Island high schools. So we're going to talk about that, what's entailed in the proposal, and some disagreement about whether it actually needs to be included in graduation requirements. So we'll get to all that. Our guests are going to be our real estate pros. We have Chad Kritzis and Sam Alpert from HomeSmart Professional Real Estate. They're going to be joining us to talk about what you need to think about if you've got to try again to sell your house. Maybe you weren't successful on the first try and you're going to re-up, and that requires some decisions. They're going to help us through those decisions, so we've got that to look forward to. In the third segment, we're going to talk about a concept called total return. Now, this is an important idea, an important investing concept that, in my experience, a lot of people lose track of and screw up. It can have a lot of tax ramifications, retirement income planning ramifications. So I want to talk about what total return is and why it's important. And then finally, at the end of the show, we have a viewer question on long-term care insurance. So we're going to get to all of that. But first up, this proposal that's in the Rhode Island Legislature to make personal finance education a mandatory graduation requirement for Rhode Island high school seniors. So sponsor of the legislation is General Treasurer Seth Magaziner, and he's actually been a guest on this show before. And he's proposing the legislation in conjunction with two folks from the State House, Sandra Cano from Pawtucket and Joseph McNamara from Warwick. And so this would make some type of personal finance education a mandatory graduation requirement. And the sponsors for this legislation make a few points, chiefly centering around weakness in Rhode Islanders' personal finance. They point to a couple of statistics, including the fact that we have the second highest student loan debt burden on average in the United States, that we are the 9th highest rate of delinquent mortgages in the United States, and that we lag the country and the region, New England in general, in terms of retirement savings. Now, personal finance education is what this show is all about, and I've noted throughout my career a surprising lack of understanding by a lot of people with respect to basic personal finance concepts. In fact, I even did a show a couple of weeks ago and talked about my New Year's resolutions, where I talked about one of my resolutions was to try to teach something to my kids that they didn't already know about money. So I think we fail as a society in many ways in trying to educate our children about personal finances, basic things like balancing a checkbook or what an investment is, things along those lines. I think the question is whether this education belongs in the public school realm or if there's some other methodology for this. Now, the sponsors of the legislation also point out that most Rhode Island schools already offer personal finance education as some type of elective. Rhode Island is only one of 14 states where the schools don't require it, however, as a graduation requirement. The sponsors of the legislation suggest that it could be executed in a lot of different ways, either a semester course or perhaps even shorter than a semester in conjunction with other material. There could be simply a proficiency exam that could waive the requirement to take the class. They also noted that you could do something that's project-based. I think it's important to point out that there are some dissenting voices with this legislation. Rhode Island Elementary and Secondary Commissioner Ken Wagner agrees that personal finance should be part of the curriculum in secondary education, but doesn't necessarily feel that it should be added as a mandatory graduation requirement. So he's supportive of integrating it into the curriculum, but it would require opening up for review the graduation requirements, which is a major administrative legislative burden. So he's concerned that making it a graduation requirement, and those requirements are already established, would upset the apple cart, so to speak. So something definitely to keep an eye on, and something to consider as a broader conversation about what we're doing to educate our children about personal finance, because the smarter they are about money, better decisions they're going to make, and the more financially secure they're going to be going forward, which is basically what we're all about, right? All right, up next, we're going to be talking to our real estate pros about what to do if you've got to try to sell your house again. Stay with us, there's more to come. Welcome back to the Money Pros. We're joined now by our real estate pros. We have Chad Kritzis and Sam Alpern from HomeSmart Professional Realty.
Yes.
So before we jump into our topic, it's a new name for you guys. You want to tell us a little bit about that?
Absolutely, yeah. New year, new company. We're really excited. We've teamed up with Dean DeTonicourt, who has a huge office in Warwick, one of the biggest offices in the state, and we've just started opening the Middletown office on Aquidneck Ave, so we're really excited.
Excellent. Well, congratulations with that. It's nothing more exciting than starting off the new year with some big changes. So
Yes.
we look forward to hearing more about that. But the subject of our show today is going to be about what to do if you've got to try to sell your home again. Maybe you listed it, you weren't successful, but you still need to sell. What kind of changes do you need to make? So we're going to be getting to that. But before we do, maybe we could talk quickly about, like we usually do, update on real estate markets for 2018. This show's being taped just after the beginning of 2019. So how was 2018 overall? And did you see much change in the fourth quarter? Stock market got a little jumpy, economy slowed down. What can you tell us about that?
Well, I think the first part of the year was crazy. I mean, it was probably the busiest market I've seen since 05, 06. And you definitely felt a little bit of a slowdown come the end of the year, the fourth quarter anyway. Just the showings and the offers were a little slower. Numbers, we always do a couple of numbers real quick. November over November 17 versus 18. Sales up, single families 2.1%, median price up 3%. However, the thing we've been talking about is the inventory is up again at 6.9%. Condos, sales up 14%, price up 2%, inventory again up 9%. And then multifamily, huge jump, sales up 25%, the median price down 7%, but the inventory up 16%. So kind of what we talked about all year is kind of coming into play was you're seeing more of the balancing of the market coming out of the really strong seller's market that we've been experiencing for the last few years. And once again, not the sky is falling, but you're just starting to see a little bit of a market correction where the inventory is starting to increase.
And I want to ask you this question before we get into the topic, because I've had this question from clients, but what do you tell somebody who feels like maybe they missed the peak, but they still need to sell their house? And that is kind of related to what we're talking about, right? So does that mean you should just like pull the house off the market and wait for another peak?
No, I mean, we're still up at the high end, right? So we know we're still at the tail end of, probably the tail end of a seller's market, right? I don't have a crystal ball. I can't tell you when it's going to go, but when inventory starts to rise, it means stuff is selling slower. So we're at the tail end of the height, so it's still a great time for seller to sell their house.
It's impossible with any asset, whether it's a stock or a house or whatever, to catch it at the absolute peak. So I don't think anybody should apologize for maybe missing the most recent one. That's a recipe for disaster. So today's topic is what to do if you didn't sell your house the first time around. What are we talking about exactly here? What are the situation?
There'll be a couple of scenarios, right? So if your house was on the market previously and it didn't sell, so it was either what's called an expired or withdrawn listing, meaning it expired its contract term in MLS, or maybe in the winter and fall months you were for sale by owner and it didn't work, and now you're thinking about hiring a professional to get the job done.
So Sam, let me turn to you and ask, if that happens, let's take probably maybe a little more common scenario that you just referenced. You listed it, it didn't sell in the fall, your contract with your real estate agent is expired. What are your options at this point?
The first question is it still the right time? If it's the right time for the sellers, then of course you're still going to sell. If it's not, you're not going to. You're going to hold off for a few months, a few years, whatever the situation might be.
So maybe there was one particular house that they were gunning for and that sold, or something has changed and they don't need to sell anymore.
Right. So now if it is still the right time, you really have two options. The first option is relisting with the same agent. If you're going to do that, you want to make sure that you find out what they're going to do differently to still be, to be more effective this time around. The other option is to interview some other groups and see what they have to offer.
So, in my town, I live in Barrington. You can't swing a dead cat without hitting a bank or a real estate agency in that town. Do I just, pick up the paper and, pick something? Like, what do I do at this point? Because this is a problem I've faced before.
So I'm going to give you a common example we like to use pretty frequently. If you have a cold, you're just going to go to your local practitioner in town. If you have a much more serious medical condition, you're going to make sure that you find an expert. Doesn't matter where that expert is, you want to work with the best. So when you're selling a home, it shouldn't be any different. For a lot of people, this is the largest financial investment they're ever going to make in their life. So you want to make sure that wherever that person might be, they might be 5 minutes down the road, they might be 15, 20 miles away, but you want to work with somebody that understands the market and not only specializes in listing homes, but really is an expert in maximizing their value and getting them sold. And Oliver, let's be honest, this is Rhode Island. Who is really that far away?
Well, I think that is what you just pointed out is the assumption that I would make is that the agents that live and work in my town are going to be more familiar with my marketplace maybe than somebody that's out of town. Is that not always the case?
If you show Warren Buffett a profit and loss statement, he's going to let you know if it's a successful business, something that he'd be interested in investing in. If you show us, if you show a professional and expert what the comps look like, what the market is looking like, the inventory that's active and selling recently. Doesn't matter if it's in Wakefield, in Warwick, or if you put us in the middle of Des Moines, Iowa. We're going to be able to tell you what the price of the home should be, and we're going to be able to put our systems in place in order to maximize your investment.
Okay, so I find some candidates that seem like they might be able to get the job done. I think you'd probably suggest we sit down and talk first before we sign on the dotted line. Mm-hmm. What kind of questions do I ask a real estate agent to try to figure out if this person is the right one for me?
Right. Well, you got to remember, you're starting a relationship with somebody here. You're going to be working together for the next 2 months, 6 months, 9 months. So you got to make sure whoever you're hiring, you have a good relationship with and you can get along with. I mean, you also want to look at historically what's their track record. Right, as we said, I mean, you're a financial guy and you're great at what you do. You need to make sure you have somebody that has a track record of getting the home sold. I mean, anybody can take a listing and throw it in MLS and pray that it sells. That's not what we do. There's a lot more to it than just hoping that we're going to throw it in MLS and the house is just going to sell. So you want to look at the agent's track record.
Do I just ask that, like, how have you done, or like?
Absolutely, I would ask you if I was interviewing you for the job.
Okay.
Right? How have you done for your clients? What's the percentage of sale price versus list price? Those kind of questions. Marketing, advertising, testimonials are very important. What do clients have to say? Sometimes clients will ask for a list of referrals, and they'll call our previous clients and ask how we did. So you got to ask really, how have they done, and how long have they been doing it, and what's their track record of success over the years?
What about who you're going to be working with? Is it important to know, am I going to be working directly with you, or am I going to be working with an associate? Or you talk about the relationship being important. Is that a factor?
Well, the relationship's always important, right? We get calls all the time because we know the person, right? I know your kids, friends, parents from school.
Sure.
The people the gym or the grocery store, the people you meet. That's where the relationship is in this business, right? People call me because I know them and I've done deals with them in the past, or our kids know each other. Whatever it is, the relationship is really with the agent and the client, and you got to be able to deal. Call me anytime on my cell phone and have a conversation, and not feel like it's a pain or a burden. I mean, it's really a relationship we're getting into for the next number of months.
So I feel like as I look at real estate listings and the signs in my neighborhood and things like that, one of the things I'm noticing is it's becoming more and more common to see a team indicated, right?
Mm-hmm.
So I'm not talking about just the brokerage firm, but the so-and-so team at such and such real estate agency seems to be a more common practice. What's the difference between working with John Smith, who's a real estate agent, or the John Smith team at a particular real estate agency? Does one situation offer more benefit, or are they just different? What do I need to know about that?
I wouldn't say either is more beneficial than the other. It's really what that group or individual is going to be able to offer you. With an individual agent, you're going to work with somebody. They're going to handle all the communication. They're going to do all of your marketing, your negotiating, open houses, your showings. They're going to handle it all. And for a lot of sellers, that's a relationship that they really are looking for. And there's a lot of agents out there that have built very successful businesses doing that. For us, what we found, in order to do the volume that we've done, 225 homes the last 2 years, in order to do that most effectively and really maximize for our sellers, I'm not spending my time putting together fancy flyers for prospective business. If I am doing that, then I don't have time to really, I can't solely focus on negotiating for my sellers. I can't prospect for new buyers for my sellers. I'm not able to hit the phones finding people that aren't necessarily working with an agent but are very interested in that home if they were to know that it was available. Additionally, for us, we're not. Right now, we actually have showings going on, and we have other people on our team that are helping with that. If I was working on my own and I had a showing request for right now, I'd have to tell those buyers and their buyer's agent that I'm sorry, I have a prior commitment, I can do today at 5. What I worry about is if I'm waiting until 5, are they getting into another home that if they would have seen mine, they would have bought it, but they saw this other one first and now they're going to jump on it. You know, for us, we aren't really able to maximize our efforts without the systems that we've been able to put in place.
Okay. The other thing I'm curious about as I look at the signs in town is, you know, they're all different colors. You got the gold ones and the red ones and the blue ones and all different varieties. And of course that represents different, you know, real estate firms. I think you'd call them brokerages,
Right.
and correct me if I'm using the terminology wrong. But how important is the color of that sign, let's say, versus the individual or individuals that are doing the work for you?
Well, we started this conversation with us switching brokerages
Right.
this year, right? I mean, so the relationship, once again, we just said is with the agent. Now, does the brokerage matter at all? Of course. I mean, you want some sort of presence and international marketing. They help with a lot of that stuff. But predominantly the relationship is with the client and the agent, right? And we moved 30 listings over in a day. It wasn't, you know, they were more concerned about our team and the Chad Kritz's team and was there, as long as they weren't going to miss any steps or marketing, they were just as happy to be with us, you know, no matter what color flag we were flying.
And last question, I'll put it to you, Sam. Should I buy and sell with the same agent if I'm getting out of one house and getting into another one?
What I find, if you're staying local, it definitely does help from a communication standpoint to have everything be very streamlined with one person. On the flip side, there certainly are situations that it does make sense to work with 2 different people. The most common is a relocation. If I'm working with a seller out of Wakefield and they're buying a house in North Carolina, I'm not going to be able to help them out with that. So being able to find them the right professional, somebody that's very successful, that I have a good relationship with, and I have the trust that they're going to do a great job for my clients, that's who they need to work with.
All right, I'm going to have to hold you there, but great information as always, and congratulations on the new change. Up next, we're going to be talking about total return, so stay with us. There's more to come. Welcome back to the Money Pros. Time for a little Investments 101. We don't get down into the nuts and bolts of investments that often on this show, but I think there's an important concept that more people need to be familiar with when it comes to investing, and that's the difference between, or what the concept of total return is, and the difference between income and capital appreciation. There's really 2 ways you can make money when it comes to an investment, and it's either income or capital appreciation, and sometimes you can do both. But I want to talk about those 2 concepts. So let's throw a slide up on the screen. Let me see if I can illustrate that for you guys. So the first bar I have here is dividends and interest, and that is the category of income. If you think about a rental property or something like that, you could receive rents from the property. That would also be income. The second category, the green bar there, is increase in value, and that's considered capital gain or capital appreciation. So the idea that you buy something for $1 and it goes up to $2. Now, these are 2 entirely different ideas. One is the idea that you buy an investment and it gives you income while you still own the investment. The other is that you buy an investment and the investment itself increases in value. When you stick these 2 things together, you get the concept of total return. In other words, what is my total increase in value on this investment, which can include capital appreciation or capital gain, as well as income in the form of dividends, interest, rents, etc. So this is the concept of total return. So here's what you want to know, okay? First of all, investments can have some or all of this. So take a stock, for example. A stock like Apple is going to be essentially exclusively capital gain. You're going to buy it for $200, and hopefully it goes up to $230 and not down to, you know, $175 or wherever it's at right now. But the idea that you're buying it for an appreciation in the stock price. You can also buy stock that has appreciation or depreciation, but it also pays dividends. So there's an example of an investment that can have both. Bonds, same thing. You buy a bond, it's going to pay income in the form of interest, but the bond value can also change, and that would be capital gain or capital loss. So that's a component of total return. A mutual fund, same idea. You can have a mutual fund that can own multiple investments, stocks and bonds, and you can receive everything from that mutual fund. You can get capital gains as the share price of the mutual fund increases. You can get dividends from the stocks that are held inside that mutual fund. You can also receive interest if that particular mutual fund also owns bonds, which is not unusual. So investments can provide a variety of different sources of return or total return. Why is this important? First of all, in some cases, you need to realize that you don't care. And some people get overly hung up on the income piece, which is also called yield, to the detriment of other sources of return. So if you're just seeking to grow your money, as an investor, you shouldn't really care where the return comes from, because total return is total return. If it comes from gain, so be it. If it comes from income sources like dividends and interest, that's good too. But you may not care. The other thing is, when you're in retirement, you don't have to just focus on income, because you can spend capital appreciation. You can sell an asset and use the proceeds to live on. So don't get too hung up on that. But there are some situations where you do need to get hung up on what type of return your investment generates. Typically, those are situations where you care about taxes, because in many situations, interest and dividends can be taxed differently than capital gains. So you want to consider what tax brackets you're in and what investment vehicles you're using, whether it be IRAs or taxable accounts, and perhaps be clever about where you put different investments based on the type of return they generate. All right, so that's a brief dissertation on the concept of total return. When we come back, we got a question on long-term care insurance. Stay with us, there's more to come. Welcome back to the Money Pros. Got a viewer question. Let's throw it up. And we've gotten this question before, and I get it all the time from my clients, so it's worth going over again. Viewer writes in, I received a letter from my insurance company, which is never good news, saying my premium on my long-term care insurance is going up. Definitely not good news. Should I pay the increase or discontinue the policy? This is the choice the people that have purchased long-term care insurance, traditional policies, have been forced to make over the past several years as these policies have gone up in premium. Now, it's not just you that's their premium is increasing. It's the entire class of people that own the policy that you own. But you should take a look at that letter, because there's probably some options in there for reducing your benefits on your current policy, which will reduce the premium. If you get rid of the policy and then try to buy another policy, it's very unlikely that you're going to be able to get anything anywhere near affordable. So it's a good idea to review the options that the insurance company has given you for perhaps reduced benefits, maybe a shorter benefit period, a lower inflation rate on the benefit, or a lower benefit amount. But those are better options than getting rid of the policy entirely. And of course, you should probably talk to your agent. Hopefully they're still in touch with you. So that's it for today's Money Pros. Thanks for watching as always, and we'll see you again next weekend right here on the Money Pros. Have a great weekend, folks. Take care. On the next Money Pros, there's a new proposal to make personal finance education a mandatory graduation requirement for Rhode Island high school seniors. We'll have the details. Our real estate pros, Chad Kritzis and Sam Alpern from Home Smart Professional Realty, will be with us to talk about what you need to know if you got to try to sell your house for the second time. And finally, what is total return and why is it important in your portfolio? Don't miss the next Money Pros this Sunday at 10:30 a.m. on Fox, or watch online at foxprovidence.com.